So whenever you look at a legacy regional bank from the outside, it projects this image of total unshakable
Right.
stillness.
Stone columns, quiet lobbies.
Exactly. Zero friction. But when you crack open the actual earnings report, you realize a bank isn't a vault at all. It is, well, it's a highly pressurized engine room.
Intake, combustion, exhaust.
Yeah. And today we are ripping up the floorboards to look at the machinery of a 150-year-old regional bank that is currently defying gravity. Welcome to our deep dive into WesBanco.
And we're looking directly at their Q2 2026 earnings call presentation and press release, which is dated July 21, 2026.
Right. For those of you listening, our mission today is to cut through the dense financial tables and really extract the vital signs. We want to understand the health and, the strategy of this bank
We aren't just reading numbers here. We're figuring out exactly how WesBanco is making its money today.
and where they're placing some massive bets for the future. So let's just go straight to the bottom line. Did this engine actually generate power?
Yeah, it did. The output on that bottom line is striking this quarter. I mean, if you isolate net income available to common shareholders, WesBanco printed $88.4 million for Q2 2026.
Wow.
Yeah, which translates to 91 cents per diluted share. And, look back at the exact same quarter last year, Q2 2025, and they were sitting at $54.9 million, or 57 cents a share.
That is a pretty radical leap. And if we strip out the noise to look at adjusted earnings per share, they landed at 92 cents.
Right, because that adjustment just sweeps aside about $792,000 in, after-tax restructuring and merger-related expenses.
Exactly. We always look at that adjusted number to gauge the true operating leverage of the bank, right? Without the drag of temporary housekeeping. But the real story isn't just the net income jump.
It's the primary driver behind it.
Their lending engine is running incredibly hot. WesBanco generated annualized loan growth of 8.3% sequentially.
And 3.5% year over year.
Right.
Which is backed up by a commercial loan pipeline that just hit a record $2.3 billion.
That's a huge number.
It is. We focus heavily on pipeline metrics because they are forward-looking. A $2.3 billion pipeline indicates their business development officers are actively capturing market share right now.
Especially in their target expansion zones. But I want to dig into that loan growth, though, because there is a fascinating tension in the sources. They managed to post that 8.3% annualized sequential growth while simultaneously taking a massive hit on the back end.
Oh, you mean the $345 million in commercial real estate payoffs?
Yes, the CRE payoffs.
Yes, those payoffs were severe enough to drag down their year-over-year loan growth by a full 1.0%.
Wow.
I mean, in the current macro environment, elevated CRE payoffs usually mean sponsors are either finding alternative private credit or selling off assets. And that unexpectedly dumps large chunks of capital back onto the bank's balance sheet.
Right. So when you visualize that tension, this massive volume of capital leaving the bank while overall loan balances still surge, it's like you are trying to fill a bathtub, but someone left the drain wide open.
That's a great way to picture it.
The water, representing their new loan originations, is blasting out of the faucet so intensely that the overall water level still manages to rise by an impressive 8.3% annualized.
Even with $345 million draining out the bottom.
Exactly. Completely overwhelming it.
And the origination velocity required to outpace a drain like that is significant.
Mm-hmm.
It tells us their commercial and industrial teams, their C&I lenders aren't just, managing legacy relationships.
Right. They're hunting.
Yeah, they're actively hunting new business to plug the gap left by that CRE runoff.
But originating a massive volume of loans brings us to the fundamental constraint of banking. You have to fund those loans. You can't just lend out air.
Right.
So if the loan engine is running this hot, how are they fueling it on the liability side of the balance sheet?
Well, this is where we need to scrutinize their net interest margin, or NIM. And WesBanco's NIM metrics for Q2 tell a very specific story about pricing discipline.
Okay, how so?
Their NIM actually expanded to 3.63%. That is up 4 basis points from last year and 6 basis points sequentially.
Expanding your margin in a rate environment where depositors are aggressively chasing yield is difficult. How did they pull that off mechanically?
They basically pulled 3 distinct levers. First, asset repricing. They are simply capturing higher loan yields as they originate new debt.
Or as variable rate loans adjust upward.
Exactly. Second, they maintained absolute strictness on funding costs. And third, they benefited from a slight technical tailwind.
The accelerated mark accretion.
Yeah, 3 basis points of that sequential margin increase came from that. When acquired loans pay off faster than expected, the bank gets to recognize the remaining purchase discount as income all at once.
Let's zero in on the funding costs, though, because that's where regional banks have been bleeding out lately. WesBanco managed to hold their deposit funding costs completely flat sequentially at 235 basis points.
Which is impressive. And when you blend in their non-interest-bearing deposits, their total cost of deposits is sitting at an effective 178 basis points.
Holding the line at 235 basis points means they aren't cannibalizing their margin just to hoard cash.
Right. They're leaning on a solid average loan-to-deposit ratio of 88.9%.
Meaning they still have a comfortable buffer of core deposits funding their loan book. But I'm going to challenge that comfortable buffer narrative based on a very specific line item in the sources.
Okay, let's hear it.
Because their loan growth significantly outpaced their deposit growth this quarter, WesBanco increased its period-end FHLB advances.
The Federal Home Loan Bank borrowings.
Right. By $375 million sequentially. They are now sitting at $1.4 billion in FHLB borrowings.
Granted, that total is down $400 million from a year ago.
True, but a $375 million sequential spike makes me pause. If you are an investor looking at this, do you see them tapping the wholesale funding market as a red flag? Like, is their core deposit engine sputtering out, forcing them to buy expensive wholesale liquidity?
It's a legitimate concern, honestly, because heavy reliance on the FHLB often signals a liquidity squeeze. But context is everything here. You have to view that $375 million increase alongside the flat deposit cost and the expanding M. If they were desperate for liquidity, they would have paid up for local deposits.
Which would drive that 235 basis point cost higher.
Exactly. Or the wholesale borrowing costs would have just crushed their margin. Neither happened.
So they chose the wholesale route deliberately.
They did. This looks like a purely tactical deployment.
Yeah.
They saw high-yielding commercial loan opportunities in their expansion markets.
And their local branch network couldn't generate core deposits quite fast enough to match the pipeline's velocity.
Right. Management clearly ran the math and determined the spread on the new commercial loans comfortably exceeded the cost of the FHLB advances. It's calculated leverage to capture market share.
Not a liquidity lifeline.
Right.
The spread works, so they
No.
take the trade. That makes sense. But, the net interest margin only shields you so much.
Very true.
If we really want to see how this bank is insulating its earnings, we have to look at their non-interest metrics, the fee income and the operational efficiency.
And non-interest income is where a regional bank really proves its sophistication. WesBanco posted a 22% year-over-year jump, bringing fee revenue to $53.6 million.
A good chunk of that was driven by service charges on deposits, right? Which hit $11.5 million. That's a 10.1% increase.
Yeah, the presentation attributes this to higher transaction volumes, but also notes they instituted new monthly fees in June.
So there's a bit of pricing optimization padding those numbers.
A little bit, yeah. Pricing optimization on a growing customer base is standard operating procedure, though. What is more indicative of their commercial capability is their swap and valuation income.
Oh, right.
They generated $2.8 million in gross swap fees this quarter.
Which indicates they are actively competing for complex middle-market corporate clients. They are originating floating-rate commercial loans, but executing interest rate swaps to give those clients the fixed payments they want.
Exactly. Pocketing the fee for arranging the derivative without taking the interest rate risk themselves. It allows them to punch above their weight class and really compete with money center banks.
You also see that sophistication in their wealth management division. They hit record levels with $8.2 billion in trust assets under management.
And $2.7 billion in securities account values. That generates a highly coveted, capital-light revenue stream that operates completely independent of the loan book.
On the flip side of their non-interest income, though, mortgage banking was absolutely hollowed out.
Yeah, it was.
It fell 55.4% year over year to a mere $1 million. But the notes make it clear this wasn't a failure to originate. Management made a strategic pivot.
Right, to keep more mortgages on their own portfolio rather than selling them into the secondary market.
Exactly.
That pivot highlights a crucial asset liability management decision. By choosing to portfolio those mortgages, they are sacrificing the immediate gratification of a gain-on-sale fee.
Right. They are taking on the duration risk themselves to lock in a steady stream of interest income over the life of the loan.
Which reshapes their non-interest income profile, but arguably strengthens future net interest income.
And that feeds directly into how efficiently they are running the back office. The efficiency ratio is the classic banking benchmark.
And WesBanco improved theirs by over a full percentage point, hitting a record low of 51.2%.
Total non-interest expense came in at $148 million. Now, I have to push back hard on celebrating this 51.2% headline number.
Oh, why is that?
When you dig into that $148 million expense line, there is a very convenient one-off item. They recorded a $4.8 million gain simply by freezing future service for actively employed participants in their pension plan.
Ah, yes, the pension freeze.
Yes. That is a pure accounting adjustment to future liabilities. It drops straight to the bottom line and drastically lowers their current quarter expenses, but it has absolutely nothing to do with making the bank structurally leaner.
That's a fair point.
So my question is, how much of this record 51.2% efficiency ratio is a permanent operational triumph, and how much is just a temporary accounting-driven sugar high?
It is absolutely a sugar high if you only look at Q2 in isolation. I mean, if you strip out that $4.8 million pension gain, the efficiency ratio mathematically ticks upward.
Right. You cannot underwrite the bank's future performance expecting them to freeze a pension plan every quarter.
No, you can't. However, if you look at their broader expense base, salaries, occupancy, technology, they are undeniably exerting tight control over their run rate costs.
So the core expenses are flat while the revenue base is expanding.
Exactly. The denominator is growing faster than the numerator. That is the definition of sustainable operating leverage.
Yeah.
So while the 51.2% print is artificially sweetened, the underlying trajectory still places them in the top tier of their peer group.
All right, so the engine is generating strong loan growth, they're managing their funding costs tactically, and they are keeping a lid on core expenses. But robust growth inherently introduces risk.
Always.
If the macro environment deteriorates, how thick are the walls of the castle? Let's look at the reserves and capital allocation.
The first line of defense is the allowance for credit losses, the ACL. WesBanco's ACL sits at a very stable 1.12% of total loans,
Which represents $217.8 million dedicated to absorbing potential defaults. But they did record a net provision for credit losses this quarter of $9.2 million.
They did.
For a retail investor scanning the headlines, seeing a bank actively pull $9.2 million out of earnings to provision for losses, well, it sounds like management is bracing for a wave of defaults in that commercial portfolio.
It's a natural assumption, but this is where the mechanics of banking regulation require closer inspection. That $9.2 million provision was not driven by deteriorating credit quality.
Oh, really?
No, or a spike in non-performing assets. It was driven almost entirely by the sheer volume of their new loan originations.
Because of the CECL framework.
Right, current expected credit losses. Under CECL, you have to estimate and set aside reserves for the lifetime risk of a loan the very day you originate it.
So under CECL, a quarter of massive loan growth mathematically forces a massive provision expense. They are basically being penalized on the income statement today for successfully growing the business.
It front-loads the pain. The provision is a function of their 8.3% annualized growth rate, not a red flag about their underwriting standards. And there is an important caveat to that 1.12% reserve ratio.
What's that?
It excludes a 1.41% unaccreted discount on purchased loans from their historical acquisitions.
I love how these unaccreted discounts work mechanically. It's honestly like buying a scratch-and-dent refrigerator from a warehouse.
That's a great analogy.
Yeah, the appliance has a massive dent in the side, so you buy it at a steep discount. Because you already baked the damage into the cheap purchase price, you don't need to go home and set aside an emergency repair fund out of your own pocket.
Right. The discount itself is your financial buffer.
Exactly. WesBanco bought these loan portfolios at a discount, so if the loans underperform, the losses just eat into the discount they already negotiated, shielding the bank's actual capital.
The scratch and dent analogy captures the accounting perfectly.
Yeah.
That 1.41% acts as a shadow reserve. It provides substantial, unrecognized loss absorption capacity that doesn't show up in the headline 1.12% ACL.
Meaning their balance sheet is materially more fortified than a casual glance suggests.
Exactly, which is reflected in their actual capital ratios. Their Common Equity Tier 1, or CET1, is sitting at 10.70%.
Intangible common equity to tangible assets is 8.44%. Both are robust. The question then becomes, what are they doing with this excess capital?
Well, they are deploying it aggressively on two fronts. First, returning capital to shareholders. They repurchased 300,000 shares in Q2 at an average price of $33.55.
And they still have roughly 4.5 million shares authorized for buybacks, right?
Yes. That signals management sees a dislocation between the bank's fundamental value and its public market valuation. But the second deployment of capital is far more consequential for their future.
The geographic pivot.
Yes. WesBanco has operated as a traditional conservative institution out of Wheeling, West Virginia for 150 years. They built their legacy in the Rust Belt and the Midwest.
And now,
Now, they're using this fortified balance sheet to fund an aggressive expansion into some of the most highly competitive, high-growth markets in the country.
Northern Virginia, Tennessee, and South Florida.
Right. They've slated new financial center openings in Florida by the first half of 2027.
They're planting their flag in entirely new economic ecosystems.
They're taking a deeply ingrained, community-focused relationship banking model and actively exporting it to the Sun Belt, noting that their commercial momentum is already accelerating in these target zones.
When you pull all these threads together, WesBanco presents a fascinating profile. You have an institution printing impressive sequential loan growth that effortlessly outpaces a heavy commercial real estate train.
Right. And they are exerting total dominance over their deposit pricing to widen their margin, using FHLB advances tactically rather than defensively.
And they are operating with extreme efficiency, fortified by a reserve profile and capital base that easily support their aggressive new growth initiatives.
They're essentially leveraging a century and a half of conservative balance sheet management to fund a highly modern, aggressive territorial expansion.
Which leaves you with a compelling strategic question to monitor over the next few quarters. As they force their way into high-growth, hyper-competitive coastal markets like Miami and Nashville, will that traditional, slow and steady Appalachian model successfully translate?
It's a huge question.
It really is. It is one thing to be the trusted local lender in a stable Midwestern market. It is an entirely different challenge to scale that exact same deeply personal relationship model against the cutthroat competition in South Florida. Can a 150-year-old engine perform just as efficiently in a completely new climate?
We'll have to see.
It will be the ultimate test of their management team, and we'll need to watch those specific expansion metrics in the upcoming quarters to see if the bet pays off. If you want to keep tracking how regional banks are navigating this complex macro environment, make sure you follow the show for our daily earnings coverage. We break down the numbers so you don't have to. Until next time.